Lots of froth, but a lot less bubble than the heady days of the dot-com bust. Tech stocks have been on a tear since tumbling in March, convincingly outperforming the broader market both here and in the US. Buy now, pay later platforms like Afterpay, which has seen its share price soar 850%, is just one of the big winners. While working from home has seen the digital revolution accelerate, there are warnings some sky-high share prices could come back to earth. Rachel Papazzoni reports.
Despite widespread job losses and a deepening recession, it turns out a global pandemic is good news for tech companies.
And if there's one thing that's working right now, it's e-commerce.
And buy now, pay later stocks are red hot. US company Sezzle listed on the ASX a year ago at $1.22 a share. It sunk to 35 cents in March, but peaked this week above $8.50. That meteoric rise, a 25-fold increase from bottom to top in the space of 4 months, has been helped by the rush from investors into tech stocks.
Generally don't like to comment on price, but I can say that I think investors are probably getting excited about our growth.
Its customers, mostly in Canada and the US, have been using the platform to do the one thing they can do in isolation.
They can't go anywhere else. They can't go to restaurants. They can't go to bars. They can't shop in stores. Their only form of entertainment is shopping online.
And Australia's market leader Afterpay has been setting records courtesy of the lockdowns. Its share price had sunk to $8.90 a share, but has since soared beyond its previous high to $73.50.
A lot of this was happening already. E-commerce was already taking share. Video conferencing was getting better. And so the social distancing side of COVID has meant that digital acceleration has been pulled forward.
With few options to put their money in an economic recession, investors are piling into technology stocks. The newly created ASX All Technology Index sunk 40% in March, just a month after launching, but it's regained those losses and then some, while the broader All Ordinaries Index is still 16% from its peak. While in the US, against the odds, the Nasdaq reached a record high this month, outpacing the much slower rebound of the Dow Jones. That kind of growth has happened before, just before the dot-com bust.
I can recall vividly the very rapid gains that were made from IPOs just before the tech crash, and the sort of enthusiasm we're seeing at the moment is reminiscent of that enthusiasm back in 2000 and 1999.
Roger Montgomery says a number of technology companies are yet to make a profit, and that's not a good sign.
When you get significant amounts of money focused on a very narrow band of stocks, that's a warning sign in itself.
Unlike the dot-com bubble, products like data sharing are in high demand because of their value to a wide range of organisations. Australian cloud company Arctis, the creator of a secure online platform Cogency, used by defence and government agencies, has seen its share price quadruple in the pandemic.
Cogency is a software as a service cloud platform for secure content and collaboration, so it fits that bill from moving that to that work from home environment.
It's just secured a contract with global aerospace and defence technology company Northrop Grumman.
We're in no rush. What we need to do is get it right, because we're in a trust economy and security has to be extremely tight.
Getting it right, something mum and dad investors are counting on in uncertain times.
This is the revolution of our lifetime. Computers will still get faster. Zoom will have a permanent imprint on our life. We may travel less, etc., etc. By how much is very hard to work out, and that's why you're seeing this volatility in the market.